about the topic. Our next speaker is, we have another group of speakers or another group of research, and I think the speaker is Dr. De Silva. If I'm not wrong, he will tell us about application of different portfolio optimization methodologies under sudden market movement in Sri Lanka, and from the Department of Business in University of Moratuwa. Let's welcome our speaker and can start his report.
Of you, dear chairs, panel members and participants, it's a privilege to present our paper at International Conference on Data Analytics for Business and Industry 2021, and our sincere thanks goes for the chairs of the conference on their brilliant support and the guidance throughout the process. I'm Pasan de Silva, and the co-authors of our paper are Harshana Lakmal, Ishara Ruwandika and Dr. S.D. Perera, Department of Decision Sciences, Faculty of Business, University of Moratuwa, Sri Lanka. Our paper we are going to present today is application of different portfolio optimization techniques under sudden market movements Sri Lankan context, which specifically addresses how portfolio optimization in the developing nation of Sri Lanka amidst the global COVID-19 pandemic circumstances is unique and significant, and how imperative intuitions gained for the benefit of market practitioners. In our presentation, we will first present an introduction to the study, the research methodology which we've used, the analysis procedure, results and discussion of the study, the conclusion we gained, limitation and perspective to future studies. In the introduction to the study, first, let's clearly identify what is the intuition behind the concept of portfolio optimization. Portfolio optimization is the method of selecting the best portfolio which gives back the most profitable rate of return for each unit of risk taken by the investors. So, the best portfolio for an investor depends upon various options like risk appetite, expected rate of return, cost minimization factors like that. Now, the Markowitz Mean-Variance Method. The Markowitz Mean-Variance Method, which is the first method of portfolio optimization that we use, hereby known as the MV method, is presented under the modern portfolio theory, which is a practical method for selecting investments in order to maximize their overall returns within an acceptable level of risk. American economist Harry Markowitz pioneers this theory in his paper Portfolio Selection. The modern portfolio theory argues that any given investment's risk and return characteristics should not be viewed alone, but should be evaluated by how it affects the overall portfolio's risk and return. That is, an investor can construct a portfolio of multiple assets that will result in greater returns without a high level of risk. However, being the fundamental implementation for the portfolio optimization due to a number of pitfalls within the MV model, it is not highly utilized by market practitioners in practical sense. So, what are the pitfalls? What are the pitfalls in Markowitz model? The most important input in mean variance optimization is the vector of expected returns, but it is demonstrated that a small increase in the expected return of one of the portfolio's assets can force half of the assets from the portfolio. Another criticism of the model is that it evaluates portfolios based on variance rather than downside risk. That is, two portfolios that have the same level of variance and returns are considered equally desirable under modern portfolio theory. So one portfolio may have that variance because of frequent small losses. Apart from that, it is considered that the MV model without constraint states resulted in unintuitive, highly concentrated portfolios with input sensitivity and also with estimation error maximization. So it does not incorporate views or asset movements by the investors to the model as well. So these related and well-documented problems within the MV model are the most likely reasons the practitioners are not utilizing the MV paradigm in practical applications. Therefore, we are moving on to our second model of portfolio optimization, the Black-Litterman model. In order to mitigate these issues that we identified earlier in the MV model, the Black-Litterman model was introduced by Fisher, Black and Robert Litterman in 1991. Let's see what's happening in the model of Black-Litterman. So in the Black-Litterman model, which we are going to call as BL from this point onward, it creates stable, mean variance efficient portfolios based on an investor's unique insights. This will overcome the problems of input sensitivity. So according to Lee's study in 2000, the Black-Litterman model also largely mitigates the problem of estimation error maximization by spreading the errors throughout the vector of expected returns. So the Black-Litterman model starts from a neutral position using modern portfolio theory and then takes additional input from investors' views to determine how the ultimate asset allocation should deviate from the initial portfolio weights. So the BL model incorporates observed market data along the investor's projection of future expected returns based on model like capital asset pricing model. So the most significant feature here is that the model essentially modifies the default Markowitz model by taking into account expectations of future performance. Now that a proper understanding is laid upon the concept of portfolio optimization and the two main optimization techniques our study is considering, the objective of study needs to be properly highlighted. So, the objective of our study is to recognize which portfolio optimization methodology is optimal under sudden market movements in Sri Lankan context, which will be highly beneficial for market practitioners in deciding their approach under sudden market movements to optimize their asset portfolios. Now we are moving on to our research methodology. So in the first section of our research methodology, we'll consider the selection of the companies and the time period we selected. So in our analysis, we selected 15 equity shares representing 9 industries in the Colombo Stock Exchange, the main stock exchange of our country, Sri Lanka. So we have selected these 9 industries as they collectively provide the highest level of market capitalization within the Colombo Stock Exchange All Share Price Index. And we wanted to portray the results of our study in a broad aspect that includes the majority of industries and fields of the Sri Lankan economy. So after selecting the industries based on their contribution to stock exchange market capitalization, the number of equity shares to represent each of the industry were selected, and we considered the largest players in each of the industries for the analysis. So the industries we selected, as you can see, are holdings and conglomerates, tobacco and alcohol, telecommunication, plantation, construction, food and beverages, tourism, banking and finance, and healthcare. And also you can see the companies we selected and their stock tickers. Now the time period. For the training period, we have selected 1st of January 2010 to 31st December 2019, a 10-year period, as we believe including data prior to 2010 tended to have outliers due to the impact of 30-year civil war we had in Sri Lankan economy. And since we are attempting to analyze the best portfolio optimization methodology under sudden market movements, we selected the COVID impact of Sri Lankan economy starting from 1st of January 2020 to 31st December 2020 as our testing period. Now we analyze the Markowitz method, the methodology we have used in our study. Here we have generated 4 sets of portfolios. They are the equally weighted portfolio where stocks are assigned equal weights assigned by EWP, the global minimum variance portfolio, which gives the portfolio with minimum variance or risk, which is denoted by GMV, the optimal risky portfolio, which gives the portfolio with maximum Sharpe ratio, or the portfolio which provides a maximum return for an additional unit of risk, denoted by ORP, and the maximum return portfolio, which gives the portfolio with maximum returns. So we have selected these portfolios by randomly allocating weights to the stocks. We selected the 15 stocks and identifying expected returns and variance for 20,000 portfolios that we have constructed, which we are going to visually address later in our presentation. Now let's move on to Black-Litterman method. So far we have presented the procedure under the MV method, and now need to properly recognize the approach we have taken under the BL method. In that, the first step is the prior distribution. So in the initial distribution of the BL model under the prior distribution, the Black-Litterman model uses equilibrium returns as a neutral starting point. So the equilibrium returns are the set of returns that clear the market. In that case, the equilibrium returns are derived using a reverse optimization method in which the vector of implied excess equilibrium returns is extracted from known information of the prices of the stocks, which is shown here in the first equation, the implied excess equilibrium return vector, which is of course the mean of the prior distribution. Now let's move to the view distribution. So more often than not, investment managers have specific views regarding the expected return of some of the assets in a portfolio, so which differs from the implied equilibrium return. And Black-Litterman model in this case particularly allows such views to be expressed in either absolute or relative terms. In this case, however, in our study, we have only incorporated absolute views regarding the performance of the 15 stocks, and I should here point that one of the more confusing aspects of the model is moving from the stated views to the inputs using the Black-Litterman formula. So usually the model does not require specific views on all the assets, but for the betterment of the results, we decided to provide an individual absolute views on all the 15 assets. Therefore, the view vector here is a 15 by 1 column vector, and the uncertainty of the views results in a random, unknown, independent, normal distributed error term vector denoted by epsilon here, with a mean of 0 and a covariance matrix denoted by omega. So the view is presented in the form of Q vector plus epsilon vector. Now we move forward to the posterior distribution. So the combining prior distribution and view distribution gives the Black-Litterman main function distribution calculation of the expected value of the Black-Litterman main function. So you can see that using the reverse optimization process, as in using the expected returns of the posterior distribution, the weights of the BL model is calculated. So we have analyzed both our portfolio optimization methodologies, MV and the BL models. Now let's move on to our findings and the analysis of our study. So in that case, we will be first considering the efficient portfolio frontier. So in the MV method approach, I previously said that we would visually present to the 20,000 portfolios we generated, and now we can see that under the MV method and recognize 4 sets of portfolios. You can clearly see the points of global minimum variance denoted by the red point, maximum Sharpe ratio denoted by the green point and the maximum return point, which is denoted by the blue point. So let's move on to the trading period performance of these 4 portfolios. Here you can clearly see that the global minimum variance portfolio has a low return with a low risk, where the equal weighted portfolio displays a low return and a very low volatility when compared with other portfolios. And when we consider the MRP or the maximum return portfolios, it has the highest return, which is as expected out of the 4 portfolios, and also has the highest risk, because we need to remember that the higher the return, higher the risk. So compared with other portfolios, we can identify that ORP, optimum risky portfolio, is with a fair amount of return and risk. So these results are justified by the Sharpe ratios of each portfolios as well. Now let's move on to the Black-Litterman portfolio allocation. In here, I need to specifically mention about the views that we have generated here. So as I said in the methodology, the view generation is probably one of the most complex tasks in the BL procedure. So here all the authors, including myself, have used our own personal opinions regarding the performance of the 15 stocks to predict their movement in the testing period of the year 2020 at the end of 2019. First, solely on a quantitative basis without any constraints, we use the training data within the ARIMA or auto-regressive integrated moving average model to predict the movement of the stocks for the testing period. Then, the problem arises was the direction of the price movements for each stock. So for that, we considered multiple factors in the process, such as the status of the stocks, the status of their respective industries, and the country's economic situation. All of them were at the end of 2019, along with the potential future effects of COVID-19 in the market. And finalized our absolute view for each stock. So I should point out here that a positive view would represent a prediction of increase in prices in a stock, and a negative would represent the prediction of decrease in prices. So as you can see here, these are the 15 views we have determined for each of the stock, 15 absolute views. So for instance, if we consider JKH or John Keel Holdings, we'll see we'll predict an increase in prices for the testing period by 0.03404, and in Expo or Expo Holdings, we predicted a decrease in prices for the testing period by 0.090. Now let's see the portfolio optimization and the sudden market movements, the highlight of our study. Here we need to first categorize the 2 sub-periods of our testing period. The first testing period is divided into 2 categories. The first period begins from 1st January 2020 to 30th June 2020, and the second period begins from 1st July 2020 to 31st December 2020. Both are equal in 6 months, but the reason we divided the testing period into 2 subsections was because we wanted to clearly recognize whether there are any significant fluctuations of stock performance between the 2 sub-periods, because in the first testing period there was a significant downward fluctuation of prices because of the government imposed a restriction because of COVID-19, and then in the second period it slowly started to recover. So let's see the comparison of all the MV and BL portfolios. So here we have 4 portfolios under the Markowitz allocation method and 1 Black-Litterman portfolio. So here we can see firsthand by looking at the Sharpe ratios that all the constructed portfolios have negatively performed below the risk-free rate. But however, this is an outcome we expected, because testing period was associated with significant market fluctuations with responding to COVID-19 outbreak, and the lockdown of the country actually interrupted the market procedures. And as you can clearly see here, even in these circumstances, the BL model provided a much higher expected return by accepting bodies compared to all the MV models. So therefore, in comparison on the effect of sudden market fluctuations, we can clearly recognize that the BL model incorporated with absolute views is the least underperforming model, which is associated with the highest Sharpe ratio. Now let's consider the Sharpe ratios of 2 sub-testing periods. So here, out of the MV 4 portfolios in the MV model, we have selected GMV because it performed the best among the 4 portfolios. So we'll be comparing that with the BL model. Here, in the first sub-period, neither the models provide acceptable results from the point of a rational investor, and in this case also, we can be clearly identified that for the negative reason for negative Sharpe ratios is under both MV and BL methods. In the first sub-periods of a testing period, short selling was not allowed in Sri Lanka. So in the first sub-period, a bearish market condition was caused by the COVID-19 pandemic, and we observed a price decrease in the stocks. So by we, I mean the active investors on the market. So since short selling is not allowed in Sri Lanka, investors couldn't liquidate assets for a positive cash flow. But in the second sub-period of the testing period, the market started to recover from the impact of COVID-19, and therefore the increase of prices were expected, and they started to stabilize. The prices started to stabilize. So investors were able to increase the value of their respective portfolios, as we can clearly see with the positive Sharpe ratios in the second sub-periods for both MV and BL models. And you can clearly see here, BL model for this period vividly outperforms the MV model with a Sharpe ratio more than twice the global minimum variance. So at the end of the analysis of study, we come to the conclusion that we identify under certain market moves in Sri Lankan context, the BL model is optimal than the MV model. So in concluding, we have identified that both portfolios under the MV and BL model had negative Sharpe ratios for the whole testing period. For the first sub-period of the testing period, also MV and BL model had negative Sharpe ratios, but in both those circumstances, BL model was the least underperforming one. And when it comes to the second sub-period, we clearly identify that the BL model significantly outperforms Markowitz portfolio, coming into the conclusions that when Sri Lankan economy started to adjust to the sudden market movements caused by the COVID-19 pandemic, the BL model was more optimal compared to the MV model. And finally, we are considering the limitations and future work of our study. So the first limitation is the scope of the study is quite limited because the views were not incorporated with thorough equity research, and as well as for future studies, we would like to recommend using equity market research based views for the study, and also relative views to the study, comparing performances of assets in the future perspective. And therefore, even for future studies, we would like to recommend using unsupervised learning techniques associated with machine learning, such as principal component analysis, as well as techniques like deep reinforcement portfolio analysis. And finally, there's a list of references we referred in our paper, where we are very grateful for the authors for their contribution to the field, as our study would be possible without the strong foundations laid by them. And so here, this concludes our presentation on our paper, application of different portfolio optimization methodologies under sudden market movements in Sri Lankan context. Thank you and have a great day.
Thank you very much for your fruitful presentation. The floor for the listener. If you have any question, please, our doctor and presenter is here, Dr. De Silva. If you have any question, the floor for the question, please. Yeah, well, if you allow me to ask a question, I think there is a light at the end of the tunnel of COVID-19 now. Actually, do your, for example, model can predict the future, what's gonna happen in the future for the market? It's gonna, for example, there will be slight improve, or it will be jump improve?
Yes, so in this context, we were considering the application of Markowitz and Black-Litterman methods, which are solely considered about the expected returns of the performance of assets we have selected in the selected portfolio. But as you have said, our next focus, which we are currently working on, is applying deep reinforcement learning techniques, where we are building a reinforcement agent which would learn itself, and it would consider the changing market circumstances. So in that case, if we provided sufficient information, the model would be able to predict and consider the currently happening market circumstances, and then provide a much more, much more optimal allocation of assets in a market that we are considering. But the thing in Sri Lanka is, Dr. Khalil, we are not applicated aspects which are commonly used in other global markets like short selling and derivative. We don't have derivative market, so the study is only limited with the application of equity stocks. So there might be a limitation with that if we consider from a global perspective, but we are developing on that. So when we come into the implementation of those techniques as well, I believe combining our current study with the deep reinforcement learning techniques, we would be able to provide a much more insightful output for the rational investor to consider.
Thank you very much. Any further question from our audience, from our listener? Okay, let's thank Dr. De Silva. Thank you very much for your insightful presentation.